we're basically 3/4 of the way through earnings season, and I think it's worth looking at the numbers here to rise above some of the noise that we're hearing about what's happening with companies and the tariff talk that's going on. 72% of S&P 500 companies have reported so far. We're seeing corporate earnings that are favorable. They're lacking the punch of recent high watermarks, but 76% of these companies have delivered EPS results above consensus, which is just below the 5-year average of 77%, but still above the 10-year average of 75%. So it's a modestly positive signal in what's otherwise been a difficult few weeks. On the aggregate level, companies are posting earnings 8.6% above estimates. Again, just shy of the 5-year average of 8.8%, but well above the 10-year average of 6.9%. So we're seeing a beat rate and upside surprise that are historically consistent, but not necessarily market moving. Thus far, the companies that have reported these 8.6% earnings above expectations, it's noteworthy because it's above the 1-year average of 6.1%. So we're seeing that companies are coming through this earnings season with a little bit better than expected. Going into Q1, we were looking at single-digit earnings growth rate. We come out of it with double-digit earnings growth rate, closer to 12%. All in all, while earnings season isn't finished, the tone is largely set. It has not been a problem for the market. Now, part of the reason I bring this up is because over the last few weeks, the volatility at the index level was so high, a lot of people stepped away from trading some of these earnings releases to focus on S&P, NASDAQ, what have you. Yesterday on Overtime, Mike Butler and I were talking about this. Now that volatility has calmed down in the indexes, are we going to turn our attention back to some of these earnings releases moving forward? So I was wondering what you guys are thinking here. We have names like AMD coming up this afternoon, Walmart, Baba. How do you guys approach trading earnings during periods of high vol versus low vol in the indexes? And do you find this to be a time where traders may want to focus more on some of these earnings releases now that index vol has come in?
Well, a couple things. First of all, although, like you said, more companies have outperformed based on whatever the projections are, the up-down, because Kai shows this, the up-down number is 50-50 exactly, which it tends to come out to every time. So whatever we want to say about earnings, one thing people have to realize is that regardless of what companies report, whether they say they're doing better, worse, whatever, every time it comes out to 50-50. 50% are up, 50% are down. Doesn't matter whether the numbers are good or bad or whatever. That's the first thing. Second thing is, as you can see from this earnings cycle, when implied volatility is high, like it is now, earnings plays are much more interesting and much better. We've played virtually every major stock this cycle, and Palantir was one of our biggest winners last night. But we've only had one big loser. It did do some damage, so be fair, because it did damage, was Microsoft. The only thing that traded way outside of its range of every single stock that we've traded, which is probably 50 earnings plays so far, is, and I'm not saying they were all winners, because there's some break-evens, there's some losers, but the losers were small, the break-evens were, up or down, basically nothing. And there were a lot of big winners, but the one big loser was Microsoft. That says, so far this earnings cycle has been great for self-directed, traders selling premium. Because most of the trades have been, they haven't even been tested. Microsoft was the only one that I can think of that's a major stock where it tested you and then it kept going.
Agreed.
Today, Microsoft's only down 250. It's been.
And Apple tried to stage a rally. It's only down $1 now, but
Microsoft's down $1. And PLTR, which we covered, is down 15. So I think it's going to be a good cover.
Apple was flirted with 200 a minute ago. It got up to 199.88.
Yep.
197.80. $2 lower.
Sorry, go ahead.
Sorry, yeah.
Well, one of the stats that of course. One of the stats that we like to check in here when we talk about earnings, we go over this about once every 3 months here, is how are companies being rewarded or punished by the market for beating or missing their estimates? The market right now through the first quarter is showing a stronger than usual appetite for upside earnings surprises. In Q1, S&P 500 companies beating EPS estimates have seen their stock prices rise an average of 1.6% in the 2-day window before and after earnings, which is above the 5-year average of a gain of 1% during the same period. On the flip side, negative surprises being met with only average levels of punishment. Companies missing expectations this quarter are seeing an average drawdown of 2.3% in the 2 days before, 2 days after window, which is exactly in line with the 5-year average for downside moves in the earnings window.
There's a problem, Chris. There's a problem with that. There's a big problem with that. When this earnings cycle first started, we were much lower. And when you're much lower, negative surprises don't hurt stock because they've already been killed. Now that we've rallied, had this monster rally in the last 10 days, you get a positive surprise like PLTR, and they kill the stock. So it's not the source of the information is not taking into account the market move, like where the market is. When the market's oversold, negative surprises don't really hurt the stock. When the market's overbought, positive surprises don't help the stock. So you can't take it out of context, and that's essentially what that that
was the third step in this journey, Tom. We're building up to a story here, but
I know, but that's the whole reason. So you'll get a stock like,
but that is the reason.
Yeah, that's the whole reason.
I think that context matters, right? Like building this up, earnings have been good, stocks are beating, but the context is because the market had come down and the bar was so low. Yeah. And when we take a step back, right, when were companies being punished for earnings a few months ago? When the stock was on highs. Back in the second quarter, third quarter, fourth quarter last year, we'd frequently note how companies were being punished more than rewarded, and it's because we were sitting on the highs. This may be a function of us coming off the lows and us just having gone through an earnings season when the market was down nearly 20%.
Yeah, that's your answer. Okay, what else?
So we've rounded onto that. Well, I think we should talk about what's going on with the Fed tomorrow. You and I had the pleasure of kicking things off this week on First Call, and we found ourselves in the unusual position of agreeing on an outcome for perhaps two different reasons. The Fed right now going into tomorrow, according to the CME Group's Fed Watch tool, which is, I think, as you noted, Tom, the most visited website page that they've ever built for anything altogether. They're telling us there's a 2% chance of a cut this week. But more importantly, there's only a 30% chance of a cut in June. And that's been a dramatic downshift over the past 10 days when the market was favoring a June cut. Believe it or not, all the information that's come out over the past week, from GDP to non-farm payrolls, reinforces a view that the Fed may not be able to move right now. So from my particular perspective, Tom, and I think you agreed as well on Sunday, even though the Fed may not cut this week, what we're seeing in the bond market with relatively elevated a state of volatility compared to, say, equity indexes, there may be an opportunity to look short put spreads or find some long deltas in bonds here, because implicitly, if the Fed doesn't cut, they're not fanning inflation. And it's almost a mirror image of what we saw in September. The Fed cut 50 basis points in September, and yields went up because the market priced in faster growth. This time around, no cuts, no faster growth being priced in, yields can stay lower. I'm leaning long deltas here. I think it's an interesting play still. We had a nice little pullback at the start of the week. I think it's a gift. We do have the Trump line in the sand, after all, 4.5% of the 10s, 5% of the 30s. I'll continue to trade around them because I don't think the administration is going to give up its yield narrative.
Oh, I don't think the administration is going to give up the yield narrative, and I don't think that they. I don't think that was ever part of the. I don't think they actually. This administration needs help right now because the optics are so bad, and they don't want the Fed to actually lower rates right now, even though they say they do, because right now they have the perfect scapegoat in the Fed, and so I don't think that's even. I don't even think that's on the table. I mean, nobody's going to look at bonds at 114 and think that we should be lowering rates tomorrow. I mean, it's not possible. So anybody that says, like, if Trump comes out tomorrow and says,
we could go at 117, 118.
Maybe you could have justified it.
Right, could justify it.
At 114 right now, you cannot justify it, no matter what.
The market's saying you're not doing it.
Yeah, the market's saying forget it, not a chance. And so if Trump comes out tomorrow and says, well, this is all on Jerome Powell, he sucks, he should have lowered rates. It's all optics. It's all bullshit, because he knows you can't lower rates here, so he can still.
It's a soundbite like anything.
It's just a soundbite, yeah. Mm-hmm. So there is no lowering rates here. The question is, what do they say? Because everybody knows they're not lowering rates. So what do they say? So, I mean, Powell's going to say the same thing he said all along, because at this point he's got to show strength and independence. he's got to show that he's objective. And so he's going to continue to say what he's basically been saying all along. In a perfect world, we'd love to lower rates, but we're not there yet. There's too much uncertainty. And that is a reasonable answer. Trump will say that's not a reasonable answer, but he gets to throw Powell under the bus still. So that's a good situation for him.
Everybody's always looking for somebody to throw under the bus.
That's his thing. Yeah, he's got to throw somebody. And
throw me under the bus every day.
There you go.
And now it's your turn, Chris.
But I guess my point here is that
shit rolls downhill, Tony.
I don't expect much to happen, but I will say this. I think bonds are way too low here at 114. I've been buying them this morning. I'm down a little money on them today. I want to buy more. I think they're the best risk reward on the board because I think they have kind of like a built-in floor here. Mm-hmm. So I think they have a better risk reward than stocks. And if I was going to be long some asset class here, I mean, if I had to pick an asset class, it wouldn't be precious metals because they're just stupid.
Because they just go up every day. I wouldn't want to be long those. Mm-mm.
It wouldn't be digital assets here because they've already had a massive rally. It wouldn't be stocks because they've already had a massive rally. And so if you want to pick something,
they're mid-range for the year. I mean, we started the year at 6,000. We went down to, I'm going to say 5,000, and we're 5,600. I mean, I threw out the lows, I threw out the highs.
Yeah, I'm just saying, I think
we're mid-range on them.
I think bonds are cheaper than stocks.
Okay,
that's all I'm saying.
I give you that too.
So I think if you had to pick an asset class here, that'd be the cheapest asset class.
Just as a note, perhaps from my own perception, it seems that you guys are shifting away from there's the attitude of the only thing that you should trade is the stock indexes, which in fairness, when you have 100 IVR and ES, why bother trade anything else? Do you guys find yourself looking at other markets more now that we have a VIX term structure that's back in contango as of this morning?
Well, to be fair, I mean, the reality here is that we have always been pretty active in equities, since we started Tasty. Prior to that, it was mostly indexes, but for the last 14, 15 years, we've been pretty active in, we like trading earnings generally. And we like,
even though we bitch, moan, and groan about it,
we like the higher implied volatility of different certain stocks. And there are situations right now, like one of the stocks that I've been buying this morning is Apple, just because it's down, whatever, from 213 to 197.5 in 3 days.
Yeah. 4. I mean, this is the 4th day.
Yeah, but I'm just saying, like, to me, that's interesting. Like, I'm not going to buy Palantir today, but traded 130 last night on the curb. It's trading 106 this morning. That's kind of interesting, but I'm not touching that yet. I guess my point here, Chris, is that as indexes go, we're still short premium and stuff like that, but because of
I think the market got a little bit ahead of itself too on this most recent rally. I mean, sideways to lower is not going to be out.
We've been pretty bearish since last week. It's okay. But yeah.
Well, speaking of bearish, I know that we just ran off a stretch of 9 consecutive days higher in the S&P 500. I think it's worth noting that's not something that typically happens during good times. Since the end of World War II, 80% of rallies that have been 9 days or longer have occurred during bear markets. So it's been fun. Let's just be careful what we wish for.
Do you think this is a bear market?
Yes.
You really do?
I think this was a bear market rally.
One hell of a bear market rally.
Yeah, plus I'm not sure.
We've seen bigger ones.
I don't know how to define. I felt like it wasn't a bear market. I felt like it was just a sell-off. I mean, we could be.
Arose by any other name. I mean, we can call every bear market a sell-off and every sell-off a bear market of 10% or more. That's what the industry has put it on, right? That's the number they've given it. I think it's silly at 5,600 that we have the same bear market that we would when the index was 700. I mean, you know what I mean?
So here's my measure. I don't necessarily look to the index to see the 20% decline to determine the bear market. I look at the the median stock in the S&P 500, right? Where are we for the average stock? Forget the tech companies that hold everything up. And the average stock in the S&P 500 was down more than 20% and is just climbing back through those levels. So I think that it's still a bear market. We've seen bear market rallies of 17, 20% over the years, right? You go back to the global financial crisis. Some of those bounces in 2008 were nasty, made you think we were out of the woods, and we weren't. So look, the port data is the one thing that's keeping me up at night when I'm looking at this, because if the stock market's going to continue to decline, it's going to be for a recession. The Port of Los Angeles has this great website, Port Optimizer, where they publicly display the container ships that are coming in. Maybe there's a bounce back coming here, which is worth noting, which is worth keeping an eye on, about a 30% year-over-year increase. But the last time we saw that, a bunch of those bookings were removed, and it became a 10% decline year-over-year for the forthcoming week. The point is that the trade isn't being resolved yet, and recession scares me because it's nonlinear, and equities don't like recessions. So we'll see.
Thank you, Mr. Vecchio.